Such people should always stay away from the share market. Is this your attitude as well? It is 11 o'clock at night. A man is looking at his portfolio on his mobile screen. The money that was looking green until morning has now sunk into red, and fear has replaced sleep in his eyes. Until a few hours ago he felt that the market would make him rich quickly. But now only one question is revolving in his mind. Should I sell, should I stay, or should I invest more money tomorrow to recover the loss? This money was not extra. School fees for the child had to be paid from this very money, the home EMI had to be covered, and the family had to be supported during a medical emergency. Now that same money is trapped in the market downturn. This is exactly where the real story of the stock market begins. The market is not bad, but every person is not made for the market either. Many times the problem is not in the market, but in the investor's attitude. The stock market can build wealth, but first, it tests your character. Here, before patience, discipline, and knowledge, your emotions are tested. One who is weak in mind cannot become strong in money. Many people do not come to the market to earn money, they come to make money quickly. The difference seems small, but losses begin from this very difference. The race of investing and greed can never run on the same path. SEBI also advises investors to understand goals, risk appetite, and risks before entering the market. This means investing is not just the name of downloading an app, opening an account, and pressing the buy button. Therefore, if a person buys shares without understanding their financial reality, they are not an investor, but a passenger waiting for an accident. It is important to understand yourself before entry into the market. First of all, those people should stay away from the market, to whom even a small loss feels like losing their night's sleep. Such people start considering every downturn as a permanent disaster. Stock prices change every day. Sometimes due to company news, sometimes due to the global market, sometimes due to the interest rate, and sometimes just due to investor mood. Uncertainty in the market is not an exception, it is a daily routine. If your heart starts pounding at every downturn, then direct stocks are not the right place for you. You need mental strength before your money grows, because the red color of the portfolio shakes the thinking of many people. For such people, FDs, debt products, or balanced financial planning could be more appropriate. Every investment is not meant for every person, and staying safe is also sometimes a smart decision. The second category is people lacking financial discipline. For those who spend their salary as soon as it arrives, whose budget is not clear, the market becomes a risky playground. If there is no account of monthly income and expenses, there is no emergency fund, and a loan is already over one's head, then entry into the share market might not be an investment but a hasty move. No one should invest school fees, rent, medical money, EMI, or the necessary expenses of the next 6 months into the market. The market is for future wealth, not for immediate survival. The market does not understand anyone's compulsion in the short term. You need money next month, but the share price can fall that very week. Selling out of compulsion often becomes the most expensive financial mistake. The third category is emotional investors. These people do not buy companies, they buy moods. Sometimes in excitement, sometimes in fear, sometimes looking at the crowd, and sometimes running behind some big name. When the market goes up, they feel they are missing an opportunity. When the market falls, it feels like everything will end. This very emotional swing makes their decisions weak. Between this fear and greed, they buy expensive and sell cheap. The market does not defeat them, their emotions defeat them. In investing, a calm mind is the biggest capital. The fourth category is people who run on tips. Someone mentioned a stock in a WhatsApp group, YouTube thumbnail wrote multi-bagger, Telegram channel gave a target, and they invested their money. Such people do not look at the company's business, debt, profit, valuation, cash flow, or promoter quality. They just need to hear that the stock will double, and the greed starts right from there. The most dangerous sentence in the share market is there is inside news. For a common investor, such news often becomes a trap, because by the time the news reaches them, the game has already changed. A stock is not a lottery ticket. It is a small part of a real business. If the business is not understood, then understanding the price movement becomes even more difficult. The fifth category is people who want to make quick money in the short term. Those who want their money doubled in 3 months are not being sold a market, they are being sold a dream. Quick money often brings quick losses as well. The real benefit of equity investing generally shows up in the long term. But the long term is also not a guarantee. It is just a way to manage risk wisely and give time to compounding. If a person gets anxious when a profit is not visible within 2 months, they cannot wait for compounding. Such a person should learn patience before entering the market. The sixth category consists of those people who check their portfolio every day. The market right after waking up in the morning, charts in the afternoon, expert opinion in the evening, and global cues at night. Their entire day gets trapped in numbers. Such a habit gradually turns investing into anxiety. Instead of the money growing, the mind starts filling with stress, and the person begins to perceive every price movement as a personal insult. The market does not make a report card for you every day. Even good businesses have to face bad quarters, downturns, and long boring phases. Without patience, even a quality stock can feel like a punishment. The seventh category is people who trade with borrowed money. Buying shares by taking a loan, withdrawing money from a credit card, or borrowing from a friend is one of the most dangerous financial habits. Because the market does not know your EMI date. When a loss happens, not only does the portfolio break, but relationships, reputation, and self-confidence also break. Borrowed money multiplies fear manifold. Leverage, meaning borrowed power, can make profits look big in the short term, but it increases losses just as fast. One who takes leverage without understanding the risk plays with their own future. This danger becomes even bigger in F&O trading. 𝐟𝐨𝐵I study has shown that a large portion of individual traders make a loss in this segment, yet people consider it easy income. Options and futures can be hedge or strategy tools for professionals, but for inexperienced people, they can become a sharp-edged sword. An advanced product in the wrong hands is always risky. The eighth category is people with a get-rich-quick mindset. Those who think that money will flow easily every day from the market by quitting their job. They start treating investing not as a business, but as a shortcut. People show profit screenshots on social media, but they rarely show losses, brokerage, tax, stress, and sleepless nights. The complete reality is not visible behind every green screenshot. Real investing is boring. Research, waiting, allocation, and review. This does not require casino-like thrill, it needs patience like farming. Planting a seed and asking for a tree the next day is not investing, it is impatience. The ninth category consists of those people who do not have an understanding of tax, inflation, and asset allocation. Making an investment decision solely by looking at the return is incomplete understanding, because money should not just grow, it must also be saved in the right manner. Money should not just increase, it must also be distributed in the right places. Home, emergency fund, insurance, debt, gold, equity, everything has its own role. A portfolio should also be like a balanced diet. If all the money is invested in a single stock, sector, or theme, it becomes a gambler's position rather than an investor's. Concentration can build wealth, but concentration without knowledge can destroy wealth as well. The 10th category is those who have full responsibility for their family, but do not have insurance and an emergency fund. For such people, the first investment should be protection, not profit. Health insurance, term insurance, and an emergency reserve might seem boring, but these are what save the family during a crisis. Market return comes later, financial safety comes first. If there is only one earning member in the house and they end up sitting with a market loss, the financial problem can become an emotional crisis. Therefore, the bigger the responsibility, the more thoughtfully risk should be taken. The 11th category is people without a written plan. They have no reason for entry, no rule for exit, and no time horizon for the goal. There is just hope that the price goes up. Going into the market without a plan is like driving a car on a highway without a destination and without a fuel gauge. The beginning may feel exciting, but panicking midway is certain. A simple investment plan should have the goal, duration, risk limit, asset mix, and review frequency in writing. Just a gut feeling is not enough because the market confuses emotions very easily. The 12th category is those who consider volatility an enemy. Whereas volatility in the equity market is normal, not abnormal. If the price never falls, then expecting a high return is also unrealistic. Sometimes the market goes up for years, sometimes it falls for months, and sometimes it stays stuck there for a long time. This is the nature of the market, not a personal attack. History shows that broad Indian equity indices have created wealth in the long term, but the path has not always been straight. Crashes, corrections, and painful phases have kept coming in between. An investor who cannot bear the midway downturns will step off the vehicle even before reaching the destination. To get long-term returns, one has to bear short-term discomfort. Now the question is, should these people stay away from the market forever? Not necessarily. Staying away is right, as long as habit, knowledge, and discipline do not change. One has to train oneself before the market. Just like learning the steering, brake, and traffic rules before driving a car, one has to learn money behavior and risk management before investing. A person who has built an emergency fund, has loans under control, and sets aside money for the next 5 to 7 years can make a better start. Without preparation, even courage becomes overconfidence. Instead of direct stocks, diversified mutual funds or an index-based approach can be a simpler path for many beginners. This can reduce the risk of depending on a single company. But here too, there should not be blind trust. Understanding the scheme, risk level, expense ratio, asset category, and goal match is necessary. A mutual fund is also a market-linked product, not a fixed return machine. Taking help from a financial advisor is not a weakness. Just as a doctor is there for health, a right advisor can give clarity in money decisions. But the advisor must also be registered and trustworthy. Keeping trading and investing separate is very important. Trading is a daily battle, investing is a long journey. The skill, risk, time commitment, and mindset of both are different, so mixing the two is dangerous. In direct stock investing, one has to understand the annual report, business model, management quality, cash flow, competition, and valuation. Buying shares just by looking at a brand name can also turn out to be expensive many times. If someone does not have this much time and interest, they should not do stock picking just because a friend earned a profit. Someone else's strategy might not match your reality. Today, apps have made investing very easy. But easy access does not mean easy money. Earlier, one had to go to the broker's office. Now the mistake happens right from the phone sitting in your pocket. Buy-sell happens in a single swipe, which is why people forget that behind it is a real business, real money, and real risk. Convenience has made the decision easy, but it has not reduced the risk. Market apps send notifications, but the pain of loss comes to your home. Therefore, control should not be on the app, but on your behavior. Investing money after seeing a notification is not a strategy, it is a reaction. A real investor's job is not to search for excitement, but to protect discipline. Sometimes the best decision is to do nothing. Silence can also be a strategy in the market. If you take action on every rumor, get scared at every fall, and become greedy at every rise, then the market is not for you yet. First, identify your money personality. In the end, the question is not whether the stock market is good or bad. The real question is whether you are ready for it or not, because the market gives rewards and also shows a mirror.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible, but in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.